morning, friends. The previous lectures we have seen various types of bond risk, and then we looked at rating of bonds, how the bonds are being rated, what are the various different credit rating agencies we have in the world and in our country, and what are the rating methodology that they use, what are its functions and merits and drawbacks that we looked at. And today we look at various factors which determine the interest rates. So there is a coupon rate or there is a yield. There's a yield is there. What are the factors which determine these interest rates? So say for example, we say 9% or 12%. How this 12% is being calculated? What are the factors before the company comes for fixing the 12%, the interest rate? What are the factors the company should keep in mind while the company determines the interest rate? That's what we are going to look at today. As all of us know, the price and yield are inversely related. Yield, what we mean is the required rate of return, or inversely related. The price of the bond falls when the required rate of return increases, and the price of bond rises when the required rate of return decreases. That we looked at. And then that's what we call it as a yield to maturity. That's what we call it as a YTM that we looked at. As the required rate of return has an important bearing on bond price, because bond price and yield are closely related. So we should know what are the factors which influence the determination of the yield. What are the factors which influence the determination of the yield or the required rate of return? There are four factors which we look at. One is the short-term interest-free interest rate, because the interest rate, that's what we look at, the risk-free interest rate. Risk-free interest rate. So risk-free interest rate is a benchmark on which the interest rate is being determined. So the interest rate, what is given by the companies, should be more than risk-free interest rate. The risk-free interest rate, what here mean is the treasury bills return, 91-day treasury bills return or 1 year treasury bills return. So as we have seen in the previous courses, what is called the treasury bills return, which is known as the risk-free interest rate return. So I'll just open the RBI website and we look at what is the current risk-free interest rate. 1 minute, I'll just open RBI website. And then let us see what is the current interest rate. Current because now it is falling. So RBI website is here. Hope all of you can see this.
Yes, sir.
Yeah. RBI interest rate is RBI is here. So policy rates. Have you seen that? Policy rates. Repo rate is 4%. Reverse repo rate is 3.35 currently. Marginal standing facility rate is 4.25. Bank rate is 4.25. Reserve ratio, that is CRR and SLR. CRR is just 3%. Just 3%. Look at the very, very lowest CRR. Exchange rate, we'll have to see in the different website. And look at the base rate, it is for a lending rate. And market trends, look at this. This is what I was talking about. Government securities, look at this. Look at this, government securities. Government securities 5.85, just 5.85. Government securities 5.85, 5.77. These are all different maturity years. Government securities 2025. The government security which got matured is 5.22. 2022 only just 3.96. The interest rates have fallen down. So what I'm talking about here is Treasury bills rate, 1 year Treasury bills return, because we cannot take the 91-day Treasury bills return. We should take the 1 year return because all the corporate bonds are maturing minimum 5 years. So the 364 Treasury bills return is just 3.62, 3.6261. So we can say 3.6, 3.6. Very, very lowest. The lowest rate forever. Look at the past 3 decades. Very, very lowest. So the company, when the company fixes its coupon rate, it should be, the benchmark is the Treasury bill return. So they cannot offer less than 3.6. They cannot offer less than 3.6. They should offer more than 3.6. So the benchmark is 3.6, which is known as the short-term risk-free interest rate. So the short-term risk-free interest rate, it is the benchmark for fixing the corporate coupon rate. So 3.62. So any clarification, anybody? Any clarification? So when you look at 91 day, so 91 day is 3.32 and 180 day is 3.54 and 364 day is 3.62. So as the maturity period increases, the interest rate increases. As we have seen earlier, the maturity period and the interest rate are closely related, directly related. It is not inversely related, it is directly related. So as the maturity period increases, the interest rate increases. So the 91-day Treasury bill interest rate is 3.32, and when you look at 181 day, it is 3.54, and 364 days, that is 1 year Treasury bills, it is 3.62. So as the number of days increases, as the number of months increases, and the interest rate increases. Okay, because the investor is holding that particular security for a longer period. So when the person is holding security for a longer period, so he has to get the higher rate of return. Okay, so as the maturity increases, the interest rate increases. Anybody, any clarification? Anybody? So the benchmark for the interest rate is the short-term risk-free interest rate. The short-term risk-free interest rate is the Treasury bills return. So here we cannot take 91 day because our maturity is ranging between 5 years and 10 years, all the corporate bonds. All the corporate bonds ranging between 5 year and 10 year. We look at government securities ranging between 20 years and 30 years. Look at here, you look at government security 2030. 2030 government securities here, that is 10 year. After 10 years, well, it is getting matured. That offers 5.91. And we look at 2022, after 2 years, the interest rate is just 3.93. So as the maturity increases, as the maturity period increases, the interest rate increases. So when you compare the 2-year maturity period, 2022, and the 10-year maturity period, government securities, you can look at the difference of the interest rate. It is double, 100% increase. So any clarification, anybody? Hello? Any clarification, anybody? Sensex is moving at 50,000 because of a lot of other factors. Vaccine has come, stable government in US. These are all important factors which influence the market. Okay. So we'll go back our discussion. So the short-term risk-free interest rate is the yield on 1 year government securities, say 364 day Treasury bills. That's what we looked at. It has two parts. How that interest-free interest, how that 1 year or 91 day Treasury bill return is fixed. It has got two parts. One is expected real rate of return, because when the person is investing, or the company is investing, or the government is investing on the government security, state government is investing on central government securities, and they expect some rate of return. That's called real rate of return, plus the expected inflation. plus the expected inflation. So these are two factors which determine the short-term risk-free interest rate. That is the expected real rate of return. The expected real rate of return is, as it is given here, it is the rate of return on which we as an investor is willing to trade on the current consumption for the future consumption. Say for example, if a person lends rupees 1,000 for 1 year, he gets 1,050 after 1 year. So after 1 year, if he is waiting, he has to get something extra. So here he is lending 1,000 rupees for 1 year and he has to get something extra. So that something extra is known as the interest rate. Okay? So he will be getting 1,050 a year. So the real rate of interest here is 5%. And the other factor which determines the risk-free rate is the inflation, that is a rise in prices. How do we calculate the expected rate of inflation? Expected rate of inflation. So look at these are three factors which determine the inflation rate. That is the changes in money supply, how the money is being circulated in the country, and changes in velocity of money, the speed in which the money is getting circulated, the speed in which the money is being circulated, the velocity of money in circulation, divided by the real output of the economy minus 1. Real output of the economy minus 1. Say for example, the money supply increases by 13% and the speed with which the money is being circulated, say for example, is 1%. The real output of the country is increases by say 7%. The expected rate of inflation is money supply, that is 13%, that is 0.13, that is 1 plus the money circulation, that is 1.13 into 1 plus the speed of money circulation, is 1%, so that is 1.01, divided by the real output, that is 1.07 minus 1, so that is the expected rate of inflation is 6.7%. So these are the two factors, how much the investor is willing to pay, willing to accept, that is the interest rate, how much he is willing to get, plus the rate of inflation. If you add both, that will give us the real time, the risk-free interest rate. So when we calculate the coupon rate, the company need not consider the inflation rate. The company need not consider inflation rate because inflation rate is already inbuilt by the government while they calculate their own interest rate. Because the company benchmark is the risk-free interest rate. So in the benchmark rate itself, the inflation is embedded. Inflation is included. So the company need not include any factor for inflation. That's the first factor. So any clarification, anybody regarding the first factor is risk-free interest rate. So risk-free interest rate is one of the factors which influences the interest rate. So higher the risk-free interest rate, higher the coupon rate. Lower the risk-free interest rate, lower the coupon rate. Now currently it is 3.9, 3.5 or 3.6. That's what we looked at, 3.6. So no company will offer more than 7%. No company will offer more than 7%. That's why no company is coming for issuing bonds now. No company is coming for issuing debentures. So a company cannot offer more than 7%. Okay, so they will add just 4% extra to attract the investors. Okay. Any clarification? Any clarification, anybody? So higher the risk-free rate, higher the coupon rate. Lower the risk-free rate, lower the coupon rate. Risk-free rate has got two components. That is how much the government can offer plus the expected rate of inflation. Any clarification, anybody? When the inflation increases, the risk-free interest rate increases. Inflation increases, the risk-free rate increases. Any clarification, anybody? All of you understood? The second one, yeah. Anybody? Any clarification? Anybody? Is it okay? Shall we proceed? Next.
Yes, sir.
The next is the maturity premium. As we have seen, 2030 government security, 2030 government security. Look at this is what maturity premium that we talk about. 1 minute, I'll take the same website. Okay, share that. Yeah. So 2030, hope all of you can see this. Hello?
Yes, sir.
Yeah.
Yeah.
2030 government security interest rate is 5.9 and 2022 is just 3.93. This is what we talk about maturity premium. This is what we talk about maturity premium. So when the higher the maturity period, the higher will be the interest rate. Lower the maturity period, lower will be the interest rate. This is what we call it as the maturity premium. Okay, the investor is holding the bonds for a higher period, higher number of years. The company should give the higher interest rate. So the 10-year bond will have higher interest rate than 5-year bond. 10-year bond will have a higher interest rate than the 5-year bond. 20-year bond will have a higher interest rate than the 10-year bond. 20-year bond will have a higher interest rate than the 10-year bond. So that is known as maturity period. Maturity premium. So I repeat, higher the maturity period, higher the interest rate. 20-year bond will have higher interest rate than 10-year bond. That is what known as the maturity premium. So it represents the difference between yield to maturity on a short-term risk-free interest rate and the yield to maturity risk for a longer period of time. So the yield curve, it is always going up according to the time. So when you draw the yield curve, okay, when we draw it, okay, this is the time of maturity. This is the yield. So the yield curve, when the time increases, the yield curve increases. Okay, this is the x-axis, y-axis. This is the yield. Okay, so when the time increases, the yield also increases. Okay, so you can draw this graph when you explain. You can draw this graph. So time and yield are closely related. They are directly related. Okay, so the yield curve ordinarily slopes upward because the investors expect a higher rate of return for making investment over a longer period of time. So when we invest for a longer period of time, so he expects a higher rate of return. So this implies maturity premium increases with the time. Maturity premium increases with the time, as we have discussed earlier. So this has got three important theories that we look at here. One is the expectations theory. Second one is the liquidity preference theory. And third one is preferred habitat theory. The expectation theory depends on the expectation of the investors. The short-term rates are expected to rise in future. That means, if it is everybody is expecting higher rate of return, that means it is ascending in nature, increasing in nature. The short-term rates are expected to fall in future. That means descending in nature. Here that we talk about the yield to maturity. Here we talk about the government security or the treasury bills. Okay, and if it is a humped means it increases and then it falls, and there's a flat is unchanged in the future. That we call it as a preference expectations theory. And second one is we call it as the liquidity preference theory. That is, the investors have preference for liquidity. They cannot sell these bonds in the secondary market, so they ask for a higher yield because they cannot sell it as we have in the in the equities. Equities at any point of time you can sell in secondary market. But whereas here you cannot sell in secondary market because it doesn't have liquid market. That's what we have seen earlier. Okay, so it doesn't have a liquid market. That's one of the important risks this bond has got. So the bond should provide higher rate of return. So they ask for a higher yield on an inducement to hold bonds for longer maturity. Okay, because we are holding it for a longer period, 20 years. So the bond holders expect a higher rate of return because there is no liquidity because the fund is being locked. For the investor, fund is being locked, so he is expecting a higher interest rate. That is liquidity preference theory. And third one is the preferred habitat theory. That is which is determined by supply and demand of funds in a different maturity period. Because during recession, the fund is limited. So the companies cannot come for issuing bonds. The company should provide higher rate of return because the fund is limited. During the prosperity period, during the developmental stage, growing stage, the company can offer a low rate of return because the fund is not limited. So the fund availability in the economy determines the rate of interest on bonds. Okay, so maturity premium here relates to the number of years the bondholder is holding the bonds. The bondholder is holding the bond for a higher number of years, more number of years, then the company has to give the higher rate of return. Any clarification?
Expectation theory, what is
Humped means either increases or decreases. It is expected to increase for some time and then fall, or it is expected to decrease for some time and then increase. That's called a humped curve. Yeah. Okay. So if the investor is holding the bond for a longer period of time, the company has to give a higher rate of return. Okay. As the time increases, maturity premium increases. Okay. Then third one. Third important factor, as we have discussed in bond risk, is the default risk. Default risk, or here default risk, when the companies have issuing the bonds, this particular factor the company should take into account. Why should the company pay more than 3.6? I'll stop this. I'll take up once again the RB website. Yeah. Why should the company pay more than 3.6? Why not the company pay just 3.6? Hello? Why should the company pay more than 3.6?
So because that's the least risk, because government securities don't have risk.
Yes. So, yeah, fantastic. Very good. Very good. Yeah, good. She's there. Raghavi is there. Raghavi? She's not there. Raghavi? Not there. Huh?
Yes, sir.
You're there. Huh? Okay. You. Afzal, no? Afzal, you only told, no?
Yes, sir.
Afzal, you give Afzal 1 mark.
Okay, sir.
Afzal 1 mark.
Okay, sir.
Yeah. So that means here in government securities, this 364-day treasury bills, default risk is 0. This 3.6 default risk is 0. All of you understood this? Hello?
Yes, sir.
Here the default risk is 0. When we come to the corporate bonds, there is a default risk. There is a default risk. So the company has to pay something extra for taking up that risk. The investors are taking that default risk. Default risk, as we have seen earlier, the company can default in paying interest and the principal amount. So that is the risk that the investor is holding it when the investor is buying the corporate bonds. When the investor is buying the corporate bonds, there is a default risk. So the investor has to be rewarded. So how the investor should be rewarded? By paying something extra. So the company can offer 7%, some 3.4% extra. So that 3.4% is for undertaking the default risk. So the interest rate is influenced through the default risk. So the default risk is one of the factors in determining the interest rate. So one of the factor for influencing, one of the factor for changing or increasing or decreasing the interest rate is the default risk. Okay. So when there is no risk of default on government securities, that's what we have seen. Default risk is zero for government securities. So, but corporate bonds may default on interest and the principal payment. So, when such a possibility exists, the investor will expect for a default premium in addition to the maturity premium, because they are holding it for a higher period, and at the same time they are assuming another risk, important risk called a default risk, so that they have to pay something extra. So, the default premium increases with the default risk. The default premium increases with the default risk. So, higher the default risk, higher the default premium. The default premium reflects the default risk as well as the state of the economy. Other things being equal, the default premium tends to increase during economic recession. Okay, so any company is coming for issuing bonds these days. On these days, the company should provide higher rate of return to attract more investors, because it's a recession period. So during recession period, the company should offer higher interest rate. When the investors turn more risk averse and decrease during economic expansion or economic growth, when the investors become more confident. Okay, this is another factor which influences the interest rate. And there are certain special features. Some bonds have got certain special features. When there are certain special features, that special feature increases the interest rate. So what are those special features? One, a call feature. At any point of time, the company can redeem its bonds before the maturity period. So if such bonds may have higher interest rate. Such bonds may have higher interest rate. That is, a call feature increases interest rate because the investors are exposed to call risk. That means the companies can redeem its bonds before the maturity period. So in such case, the company should provide extra return. A put feature means it is on the part of an investor. On the part of an investor can redeem the bonds at any point of time. So this put feature is not common. It's very, very uncommon. So a put feature lowers interest rate because the investor enjoys a put option. So when there is a put feature, put characteristics, so that particular bonds will have a lower interest rate. A conversion feature. Conversion means the bonds can be converted into equities. So such bonds will have lower. Such bonds will have a lower interest rate because it can be converted into equity. Then floating interest rate. The interest rates are either increasing or decreasing. There is no fixed interest rate. So such type of bonds will have a lower interest rate because the expected inflation rate is being included. Such type of bonds. So in those situations, in those bonds will have a lower interest rate. A zero coupon bonds, as the name indicates, there is no interest rate. So zero coupon bonds may have a lower interest rate because the investors are protected against the reinvestment risk, because they are not going to invest because the companies are not paying any interest. So the reinvestment risk is not there. So in such situation, zero coupon bonds will have a lower interest rate. Either increase the interest rate or decreases the interest rate. So any clarification, anybody, with regard to factors influencing the interest rate? The benchmark is the risk-free interest rate. The benchmark is a risk-free interest rate. So by looking at the risk-free interest rate, that is the 1 year treasury bills return of the RBI, the company fixes the interest rate. So the lowest interest rate must be 3.6. That is the 1 year government security plus extra. So plus what are things are being included? Plus one is default premium. So default risk is there. So the higher the default premium, higher the default risk, higher the default premium, higher the interest rate. And then maturity premium, higher the bond period, maturity period, higher the interest rate. So there's another factor. And what are the additional features? Additional features the bond has got. If the bond has got the call feature, there will be a higher interest rate. The bond has got a put feature, decrease the interest rate. The bond has got a conversion feature, decrease the interest rate. The bond has got a floating interest rate, that will decrease the interest rate. Zero coupon bonds, that will decrease the interest rate. So these are all another feature, another characteristics that will decrease or increase the interest rate. So any clarification, anybody? Anybody? Any clarification? Anybody? Any doubts? Anything anybody want to ask? Any clarification? Anybody? So it has been there, it's there already in the LMS. You can go through the LMS. Anybody, anything you want to ask? Any clarification? Anybody? Yeah. There's no doubt we are going to the next topic. That is the bond portfolio management. So we are going to the next chapter actually. Next chapter is bond portfolio management. In bond portfolio management, these are all the topics that we need to take into account while the investor is forming the portfolio of bonds. I mean, when the bonds become the part of the portfolio of any investor, and what are the factors, what are the things that the investor should keep in mind. Okay. In the portfolio, the bond becomes the part of its portfolio because he has got deposits, he has got bank deposits, he has got mutual funds or equity, and bond is also becoming a part of a portfolio, or he is forming a portfolio of bonds. So in such case, what are the things that he has to keep in mind while he is going for investment in bonds? The first important concept that he should keep in mind is the duration of bond. Duration of bond. So duration of bond is different from maturity period of the bond. Maturity period of the bond. Maturity period of the bond is explicitly given in the bond phase of the bond, on which every year the company is paying the bond interest rate based on the maturity period, or the principal repayment is made after the maturity period. So 5-year bond or 10-year bond or 20-year bond. So the principal payment is made, repayment is made after the maturity period. That's what the maturity period. So maturity period is different from duration of bond. Both are expressed in years, but both are different. The duration of bond is a weighted average life of a bond. Weighted average life of a bond. Okay, so the maturity period is the life of the bond. On which year he is going to get back its principal amount. That's called maturity period. The duration of bond indicates the weighted average life of the bond, which considers the size and timing of cash flow. Considers the size and timing of cash flow. So it is a weighted average of cash flow streams. So cash flow here means when we start investing, we receive interest. That's a cash flow. Cash flow for the investor. Cash flow of the investor. So we'll have to calculate the present value of the cash flow, as we have done for calculating the price of the bond. Present value we have to calculate, where the weights are defined in terms of the present value. The terms of the present value relative to the discounted cash flow in each period. Okay. So how do we calculate? This is the way in which we calculate here. This example is equation is given here. Present value into C1, that is each year C1, and present value into C2 divided by V. V is nothing but the value of the total value of the bond. Total value of the that's called the bond price. It's called V, bond price. Okay. So first we calculate the present value of each year. I mean, for example, 1,000 rupees bond, we receive 10% interest rate. So we receive 100 rupees each year. So the required rate of return is say 12%. Okay. You calculate the present value of each year. This is 100 divided by 1.12 power 1. And then next year 100 divided by 1.12 power 2. And third year 1.12 power 3. So if it is 5 years, calculate for 5 years. Then total it. Then when you bring if you add the total, you will get the bond price. You will get the bond price. Okay. And then you calculate weighted average. So weighted average means, for example, the first year, it is 100 divided by 1.12. If it comes say 97, so 97 divided by the price of the bond. We are calculating weighted average, price of the bond. And then multiply with the year. So first year means multiply with 1, second year means multiply with 2, third year means multiply with 3, then add the total. So that will give us the duration of the bond. So duration of the bond is always less than the maturity period of the bond. Duration of the bond is always less than the maturity period of the bond. Okay. So that we will take up the case. We'll take up the case. So anybody will take up the case, then you will understand how we can calculate the duration of the bond. Yeah, it's here. So the face value of the bond is 100. Coupon rate is 15%. Yield to maturity is years to maturity is 6. It's redeemed at 100 rupees. The current market price is 89.5. And the required rate of return is 18% because the yield is higher, the price is less. So calculate the duration of the bond. Okay. So calculate. There are 5-year bond, it is 6-year bond. Okay. So first year cash flow. Year cash flow. First year, second year, third year, fourth year, fifth year, sixth year. All of you can see the board? Board, all of you can see that?
Yes, sir.
Yeah. The first year the coupon rate is 15%. 15%. So 15% of 100, 15 rupees. 15 rupees. Second year 15, third year 15, fourth year 15, fifth year 15, last year 115. Got it? Hello? Got it?
Yes, sir.
Then calculate the present value. Calculate the present value as we have done for a bond price. So calculate the present value of cash flow. Present value of cash flow. Then is 15 divided by the required rate of return is 18%. That's a yield. Yield is higher. So 18%. So 15 divided by 1.18 power 1. 15 divided by 1.18 power 1. How much? 15 divided by 1.18 power 2. 15 divided by 1.18 power 3. 15 divided by 1.18 power 4. 15 divided by 1.18 power 5. 115 divided by 1.18 power 6. How much comes? 15 divided by 1.18 power 1. 12.71. Second year? 10.77. Third year? Third year how much?
9.13.
How much?
9.13.
9.13. Fourth year?
7.73, sir.
7.73. Fifth year? Fifth year how much? Fifth year?
6.56.
6.56. Last year?
5.56.
5.56. So if you add, the total must be how much? Anybody? Anybody? Without adding, anybody can see the total? Without adding it, anybody can tell the answer. Hello? Without adding, anybody can tell the answer. Answer is given in the question itself.
100, sir.
Hello?
89.5.
89.5. Without adding it, the answer is given. The question itself, the answer is given. Father will get 1 mark. Father already got 1 mark, no?
I think so, sir.
Yeah. Raghavi, give father 1 mark.
Okay, sir. Giving, sir.
1 mark. So 89. So the answer is given. The current market price is 89.5. So if you add, you will get 89.5. If you don't get 89.5, some decimal fraction difference may be there. That's due to the decimal that we calculate. How much comes total? How much comes total? I mean, it could be 89.52 or 53 or you come, but you adjust it and make it 89.5. How much comes? No, last one is how much comes? 115 divided by 1.18 power 6 last year. Last year, 6th year, how much? 6th year is not 5.56, no? 6th year must be higher. How much? 6th year is how much?
Sir, it's 42.5. 9, sir.
42.59, huh?
599.
59. So total? Total must be 89.5. How much comes? Total?
89.5.
Exact, huh?
Yes, sir.
Oh, very good. 89.5. So 89.5. Now we need to get the proportion. Weighted average you have to get. Weighted average we need to get. Okay? That is 12.71 divided by 89.5. 12.71 divided by 89.5. How much comes? It's called average. Proportion. You put a heading proportion. 12.71 divided by 89.5. How much?
0.142.
You have two decimal you take. 0.14. Okay. Then second, take two decimals. Proportion you calculate.
0.12.
0.12. Third one,
0.10.
0.10. Fourth one,
0.08.
0.08. Fifth one, fifth one,
0.07.
0.07. Last one,
0.47.
last one, 0.47. Now multiply proportion with the year. Multiply the proportion with the year. That is 0.14 into 1. Proportion with the t. Proportion with t. 0.14 into 1. 0.14. 0.12 into 2. 0.24. 0.30. Then
0.3.
0.32, no? 0.32. 0.35,
3.35.
correct? 0.47 into 6. How much? 2.22. Correct, no? Okay, 2.82.
Yeah.
Hope all of you can see the board. 2.82.
No, sir, we can't see the front side of the board. So.
Okay, now it's all right.
Yeah.
2.82. Total how much? So add the total sigma aggregate. 4.17. 4.17 years. 4.17 years. Okay. So what does it mean? It means within 4.17 years. That means 4.17 divided by 12. We put around at 7.17. No. So 0.17, 0.5 means 6 months. So 0.17 means it comes around 2 months. So 4 years, 2 months, whatever he is investing, he will get back the money. So he is investing 100 rupees. The current market price is 89. So he will get back that money within 4 years, 2 months, approximately. That is called duration. So whatever the money that he is receiving after 4.2 years, so that is his, the real money that he is getting it. That real cash flow that he is getting it. So whatever he is investing for 100 rupees, so for the current market price, 89.5, the current required rate of return, the duration is 4.17 years. Okay. That is the weighted average life of the term, life of the bond. So the yield is, for 6 years you will be getting 15 rupees. 6 years you will be getting 15 rupees, and the 6th year you will get 115. Okay. That means how many years he has to hold these bonds to get back his investment. That is called duration. So he has to wait for 4 years, 4.17 years, approximately 4 years, 2 months. So with that, he will get back whatever he has invested. Okay. So the duration of the bond is always less than the maturity of the bond. So while he's formulating the bond portfolio of bonds, he has to calculate the duration of the bond. So how many years he has to wait to get back his investment, that he has to calculate before he goes for investing in bonds. Okay. So any clarification with regard to the calculation part? Anybody? Calculation part, anybody has got any doubt? So we will see some more case studies. Then we will. Anybody has got any doubt? Anybody? Any clarification? Anybody? Any doubt? Anybody? So we will look at various properties of duration that we will see later. Any clarification? Anybody? Any doubt? So thank you very much.